Hi, my name is Bobby Taruc from Warrenville, Illinois. This will be the first episode of the Project Managing Realtor podcast.
I'm Todd Gosden. I am with Mutual of Omaha Mutual Mortgage, and I am here to support and share economics with Bobby and any questions he may have. So appreciate being here, Bobby. Thank you.
Number one, really surprising today, I was watching Fox Business, and there was a revision in the BLS report that the jobs report from March of 2024 to April 2025 just got revised
Huh?
to a downward of almost a million jobs. What are your thoughts? And I have my thoughts about this, by the way, regarding the job market, because of course, the job market really, to me, in my mind, especially for first-time home buyers and even step-up buyers, the job market is very important, of course, for people to be able to afford a mortgage payment. So, what are your thoughts about both the BLS jobs report moving forward, ADP reporting, JOLTS, etc.?
Well, I think it's just the jobs report is just one indicator of maybe a slowing economy. Right.
Mhm.
I mean, the reality is if people aren't hiring, that must mean that their cost of goods have gone up or the cost of whatever they're selling is going up and they can't afford to bring people on or potentially even pay the benefits or the salaries for those people. And I think when you look at something like that, the first thing it tells me is like, okay, there's an opportunity here is what's going to happen to the economy? Because obviously we've seen for many, many moons that revisions for the next month come and we have to see if there actually is a revision or if this is real
Mhm.
when we start seeing a decline in job growth.
Mhm.
I think the other thing you see is it's also a trigger to a slowing economy when you
Mhm.
start seeing that. And I think when you look at job growth going down, it's also an indicator to the feds, is this something big enough that we need to start creating some sort of substance around maybe dropping the federal funds rate?
Correct.
And by doing so, then it's always the question mark that everybody wants to know, including the markets. If that's the case, how much is that going to be? Because the Fed could also say, listen, we're going to wait and see what next month looks like. Is there going to be revisions?
Right.
So there's really, it's nothing more than an indicator of a slowdown. Is this a blip on the radar or is
Mhm.
this something we're creating a trend of?
I'm thinking about what to expect. There's an upcoming September meeting, and then there's also a question in my mind if Lisa Cook will be a voting member in this upcoming September meeting. I've seen some numbers, potentially 25% basis points cut with 100% probability in the September meeting, and then another 25% cut, basis points that is, in October meeting with a 75% chance or probability, then another 70% chance of 25 bips in December cut. I'm not sure if this is news to you, but
Well,
what are your thoughts about that?
my feeling is I take everything with a grain of salt.
Mhm.
I mean, this time last year, we were talking about the Feds maybe cutting rates 4 or 5 times moving into the spring market, and none of that ever happened. So the reality is there has to be a consistency in what it may look like and what it's going to look like going forward. You know, the other thing I think we have to give into consideration is that people think that just because the Fed drops rates, the short-term lending rate from bank to
Mhm.
bank, that means that mortgage rates are going to drop behind it, and they don't work that way. I mean,
Yes.
so the reality in that circumstance is this we have to remember is also the bond markets and the trading markets are actually building those basis points into their trading already.
Mhm.
So we've already seen rates drift down from 7% to today, where they're saying Fannie Mae and Freddie Mac are saying that they're somewhere around 6.28. That includes a 43% of those loans that are somehow, some way people are paying points on to drop down
Mhm.
those mortgage rates. So we really aren't 6.28. We're really at a higher interest rate where people are not having to pay the cost to buy down the interest rate. They call that points in our world.
Mhm.
I think there's so many things that could shift and change between now and then. Even a revised jobs report could shift the idea of like, no, I'm not going to lower interest rates yet. So I think that we're just on the precipice of being able to say, I think we feel a direction coming that we've been talking about for the last year and a half.
Right.
Is that the case? We won't know till it really happens, right? We can say that there's 100% probability. Well, last year at this time we were at 80 or 90% probability they were going to lower them twice a quarter percent. It never happened.
Mhm.
So the reality is we just kind of have to wait and see.
Yeah. It was interesting. You sent out the communication. You send this out weekly, And I honestly, I just got the chance to read it this
That's all
morning.
right.
And I was really surprised. It made me reread your email primarily because of what I had seen at Fox Business this morning, like I told you about, because of the revisions in the jobs report. And all of these talk about cutting of overnight lending rates by the feds. 13, I just summarized it, 13 of the 20 instances that you did a look back, I can't remember the exact ratio. It was 7 were in sync with how the Fed fund rates move in relation to the mortgage rates. And then those 5 of those instances out of 20, actually, they move in concert about 25 basis points. So in totality, it's a little over 50% of the 20 instances that you look at. What I'm saying is that there's a lot of misconception, including myself in the past, that, hey, when the overnight lending rates moves up and down, actually the mortgage rate should move in concert on a one-to-one basis. But that's not actually the case.
No, it isn't.
Why is that?
Well, there's so many other economic factors that come into it. I mean, if for example, the feds are lowering 25 basis points, to all those who don't realize that 25 basis points can equate to maybe 1/8% in the interest rate. Remember, the fact is that there's other economic conditions and they're going to impacting rates other than the Fed's decision to lower the interest rate. And if the Fed does lower the interest rate because the markets are expecting it, there's been circumstances in my career over the decades I've been doing this where the interest rates actually went up because they didn't cut enough.
Mm-hmm.
So there's really no hidden agenda here. There's no betting purpose on what they're going to do. There's only a group of people knowing what's happening, and they'll make that decision a week before when they're actually going to make the presentation to everybody in the world to hear. So to me, it's like, yes, there's economics behind the interest rates moving, but it's not always because the Fed is reacting and making changes.
Mm-hmm.
The Fed is making reactive changes to free up more money for people to be able to use, right? Because the lending costs on everything we do for goods and services and everything we buy is dropped down based on the Federal Reserve doing that. So the reality is, in a very big picture, we don't know what's going to happen.
Mm-hmm.
All we can say is we're back on a trend of that happening. The markets are planning on that happening. We may not see anything move in the mortgage rates as we've drafted down from 7% to the 6.28% of last night. And it's happened very naturally, and most people didn't even know it's existing. But right now, I believe the statistic is 47% of the loans that are actually closing are actually purchase or refinance loans.
Oh, wow, that's significant.
What's significant? That's very much so.
Yeah, we can revisit that later on. The thing that comes to my mind is that when there's a Federal Reserve Bank meeting upcoming, the thing that also strikes me is that lower rates still help people. They can have a lower loan payment on a car. If people are purchasing appliances, I'm not sure if people are purchasing appliances. Credit card rates are much lower. Businesses, if they have to take out a commercial loan to purchase equipment, purchase furniture, do construction loan, I think in the long run, it truly helps the American people.
Well, I think you're 100%
And not so
right.
much I'm not just looking at mortgage rates, obviously.
No, but that's true. I mean, the short-term lending affects the home equity lines of credit, the credit cards, the car loans, all the little things that you're talking about, the short-term loans that are paid back and forth to banks. It's very impactful to the economy. The key is the Fed never wants to go too much or too little. And it's never easy to find perfect. Because even when they think it's perfect, people are going to complain that it's too much or too little. The reality is the economy tells us over time when we should and should not do it. And that's why they're in that position to do what they do every day, is that they obviously know economics much better than all of us, and they're making decisions based on numbers that they're forecasting out that we don't know.
Yeah,
the reality is, it is what it is, and we will see what happens over the next coming months to how much they do trim it. But in order for us to really get into a place where we're going to see mortgage rates move, we may need to see 3 to 5 cuts, 0.25% cuts by the Feds in order to get us to actually move the rates. And if people are thinking, and we're asking questions today, are we going to see rates back in the middle of 5s again? We actually really don't know.
Okay.
Because we don't know how much the traders are actually baking this into their trades.
Yeah, absolutely. We'll tackle that question later on. I always get asked, and especially I met with an investor this past Sunday, is it the right time? And I always get that question with residential buyers as well, owner occupants. Is it the right time? So we'll tackle that later. But obviously, I know the answer to this question. Do you want to answer that quickly?
Yeah,
Because
sure.
we've been talking about a lot of unknowns. We'll see what happens.
Yeah.
There's a lot of unknowns still.
Well, 100% I can say right now real estate's on sale.
Mm-hmm. Oh, yeah.
Because when you're buying at prices the way we're seeing them right now, is I just said a few minutes ago that we're likely going to see, because of the shortages in housing availability,
Mm-hmm.
that you're going to see less and less houses on the market. We're in a situation right now where if rates continue to drift down, what's that going to do to buyers? That means more buyers are going to come to market to buy fewer houses. By buying fewer houses, that keeps elevating the value of those homes. So whatever you buy today, likely in 4 or 5 years, there is no question about it, you're going to have a higher valuation on your house.
Oh, yeah.
So the reality is, if you can afford it, knowingly that rates are going to come down, you should buy today at the lower purchase price, refinance when rates come down, and just write it out as the escalation of valuation goes up.
Oh, yeah. Absolutely.
So it's a no-brainer.
Absolutely. Shifting gears a little bit, but still talking on the demand side. I don't have the entire data to this, but I know you probably know this by heart. Demographics-wise, it's still, well, we know, we've talked about this a little bit in the past in our morning updates, that 50 or older, I think, that particular cohort, they're 1/3 or more than 1/3 as a ratio of the buyers. And then I believe Gen X are the second ones, and then you've got the millennials making purchases as well. So that's really surprising that the older generation are actually a major force in terms of how much they purchase homes today.
Yeah, so that's
Did
a
I
very
did,
interesting question,
did I get that?
because, we go back 15, 20 years in the markets, most people would have suggested that people would buy and sell 7 times in a lifetime.
Yes.
And now it's down to potentially 3, because the average buyer, and there's all kinds of different surveys on this, and whether it's NAR or some others, that, the average age of the first-time home buyer is 38. Well, at the rate we're going, we could likely see that number breach 40 as an average first-time home buyer.
Yeah.
Right? So that's something to consider. But the other part of it is too is that the boomers
Mm-hmm.
are holding onto their houses much longer, because why would they sell something that they're going to buy new and have the same mortgage that they have currently, if they have one? And I think the most interesting part of this is, because there's a shortage of homes, we've seen an increase in rental projects being built all over the country, right? So when you looked at, let's say last year, I think the average median age buyer was 55, 56, which is
Wow.
incredible to think about that.
Mm-hmm.
But the reality is it's not really. And what's interesting also is you look at that also, there are many different places out there would share that the average person turning 55 is looking to sell their house and just rent and live a life without having
That's
all the
crazy.
responsibility. But if you look at the rentals that are being built all over whatever part of the region of the country you're in, they're so luxurious now, with lots of space and wood floors and all the high-end things that go into the kitchen, that people are like, well, if I pay rent and I don't have to do the upkeep, then I'd rather much do that and spend more time on the road doing what I want to do with my family or my wife or whatever it might be.
Yeah, precisely. We live in Warrenville, and we've seen an explosion of rental properties. They're done now off Ferry Road by the old AMC Theater. I think it's a different name now, but in Warrenville, I've seen a lot of, really looks amazing from the outside. They look like for purchase condos, but they're actually rental properties.
Rentals.
Yeah, absolutely.
Yeah.
And even you and I spent time in Florida. I see all these developments as well. They're rental communities, even on the other side of I-75. So yeah, absolutely. That's amazing. What have you talked to someone who has done this? I mean, what's their mindset? Did they not care about the equity that they would build or lose out?
I think people
by
get to a certain
renting?
point, is if you think about how much equity has been built in the last 5 years in the housing market, it's been as much, if not greater than ever in history, just because of the elevation of values going up since 2020, right? So I think that a lot of people have this thing, well, listen, it's a lifestyle change, right? Number one, through the pandemic, we saw lots and lots of people owning second homes. That's number one. Number two is if I can choose to live in Florida or Texas or Arizona or wherever they want to live, Tennessee, I can do that now because I don't have to be in the office every day.
Yeah.
So people have choices now to do things they haven't had to. But I've had many of clients over the decades say, listen, I'm out of my house. It's a beautiful house, but I'm going to go live in the city and live the city life now.
Okay.
I even know agents that have done that. So the reality is becoming more flexible for people to do so because they can work anywhere now.
Yeah, absolutely.
So it makes a big difference what the pandemic has done. It's definitely shifted the direction of how the housing market is growing right now. No two ways around it.
Yeah, absolutely. That's something to pay attention to. Part of the discussion as well, again, this caught my eye in Fox Business this morning. President Trump is considering a national housing emergency declaration. There were some numbers about equity being outpaced by inflation. Of course, affordability, we've talked about this as really a major issue. Even just DuPage, for the most part, for me personally, I don't think I can afford the resale home prices. I personally cannot afford them. They've gone high so much. It's crazy. Some numbers with totality, 1.4% year over year, seasonally adjusted rise in property value, but forecast year over year still a 4% gain forecast. This was from totality. What are your thoughts about? You probably haven't heard this National Housing Emergency Declaration, which just hearing from it, I fear that maybe federal policies would bring us back to 2006.
Yeah, I would honestly say I can't even really comment on that topic just
Mhm.
because I haven't dug enough depth into the crevices of the program to really get it. And I don't
Mhm.
actually know there's enough information out there to even be able to have a conversation around, to be honest with you. It's one of those things that's pushed out there politically, and I don't know. And regardless of where you stand on the side of the political line, it makes no
Mhm.
difference. It's a conversation that hasn't turned in anything. And for me, if with lack of detail would be lack of um, opportunity to share what my feelings were on it. So right now,
Yeah.
I have no feelings.
Yeah. Okay, that makes sense. Talking about more so on the real estate market, again, I've talked about the page. Pete just shared these numbers fairly recently. Inventory still inching a little bit higher in the month of August versus August of 2023. A little bit dip in under contract inventory versus August of 2023. New listings actually matching August of 2023 at this point, if you can believe that. So inventory is still rising a little bit, but still, I sincerely believe the page is still pretty much a seller's market.
Well, yeah. I mean, here's the thing: if interest rates are going lower and we migrate through the winter months and find ourselves at an actual 6% rate where people don't have to um, actually pay a lot of money to get to that rate,
Mhm.
basically we're finding ourselves in an unlocking point of people that own homes that are maybe willing to start selling. Having said that, I would say that we may have a slight uptick going, at least in the Midwest, of
Mhm.
inventory,
Mhm.
but that can shift in a second if we start seeing interest rates go lower and all of a sudden now these houses are all swallowed up again because of people being able to buy at a lower rate to be able to create affordability for themselves and their families. So we may see a trend, but that trend could shift very quickly. Whereas if you're in the Sunbelt states of the United States, where there's more condos and more opportunities like that, with different laws going into effect with these associations, which really I can't get into because we're uniquely in a place to where it may shift or change by the time it gets here to Chicagoland or the Midwestern part of the country. Um, People could not afford the HOAs anymore. You know, you take Florida as an example. If HOAs go up with the significance they have been, where you're pricing people out of the market, now it's another tool that's pricing people out versus the actual mortgage itself, right?
Yeah, yeah,
It's the
absolutely.
upkeep of the homes and the condos association. So I would say we are on the cusp of seeing growth in many areas, but
Mhm.
I think if we separated condo growth from single family,
Single detached, yep.
we're going to see a big difference on inventory levels. And I think it's just a matter of time when interest rates come down. I think we have to stand back and see how much impact that's going to be and how many buyers are going to actually come back into the market
Mhm.
and actually how many sellers are going to actually put their houses up in order to create opportunities for themselves to move somewhere else.
Yeah, absolutely. Let's talk about how we can have that conversation and guide buyers moving forward next 3 months, for example. I know I always encourage people, especially the first-time home buyers. Hey, I just had one buyer. In fact, we did a consult for a Florida buyer, first-time home buyer. They have a little baby, toddler, and I was talking to Grant about this, and come to find out, we suggested that the wife actually she's working. We include the wife in the loan application because their DTI was pretty high. So one of the things I normally have a conversation with, if well, the DTI ratios or debt to income ratios are a little bit out of whack, we counsel them to take care of their debt to income ratio and take care of that unsecured debt in essence for them to be in a better place to be able to purchase a home. Anything you can add?
Well, that makes sense. I mean, the great financial position is a very hard thing in a market that's shifting the way it is, and the cost of things that have gone so up, or the basic needs of groceries and gas and all those things that we need every single day.
Mm-hmm.
I think it's made a major impact on the majority of the country. I think when you talk about people who live in the high end and the low end, and you have this middle group, the middle group is definitely diminished in a way. I think it's very difficult on people right now. And I think that people look at it and understand that there is opportunity coming, I think, for people to be able to make decisions both on their finances and how they're going to move, if they're going to move or renovate or whatever they're going to do. The reality out is there's really no way to be able to tell other than keep paying your bills if you
Mm-hmm.
can,
Mm-hmm.
and keep paying your mortgage payments, and do all the right things that we all know that we're supposed to do. And that's going to give you the greatest opportunity to be able to qualify to buy another house.
Oh yeah.
I mean, the reality is, it's difficult times. Yes, I do understand that.
Mm-hmm.
But just because people are going through difficult times doesn't mean we're going to diminish the standards to be able to allow them to buy a house. That doesn't exist.
Yeah, absolutely. Have you heard anything about? I didn't really ask this earlier. Have you heard anything about student loans and student or people who had student loans? They thought they were going to be forgiven, or there would be in, I forget the name of the term, but those are kicking back in. The student loan bills are coming back.
Yeah.
I think that it's impacting a lot of the younger buyers.
Well, it is. And I mean, obviously, student loans are a very difficult thing because the cost of going to a school has gotten so crazy out of
Mm-hmm.
hand and going up so much percentage wise year over year over year, that it does create a very difficult situation, not only for kids, but for parents that are trying to help them out with those student loans. Yes, a lot of those student loans were in a status of non-pay for a long period of
Mm-hmm.
time because of the pandemic. And
Mm-hmm.
yes, those student loans have come back to the marketplace where people need to start paying those loans or they're going to default on their loans. And the last thing you want to do is default on a government loan
Yeah,
because
precisely.
it takes you for a very long time to recover from that. So all I know is that yes, they're in full swing again. Yes, people
Mm-hmm.
are paying their debt back to the schools or to whoever lent them the money. And I would say that, um, am I seeing a default rate grow in those? Maybe slightly, but not
Mm-hmm.
very much. And I would say when you even get a default risk when it comes to houses is actually very, very small, historically small. So only time will tell on those two topics to what it's going to look like in the future.
Okay. Any final thoughts?
My final thoughts is don't be scared of the opportunity to buy a house.
Absolutely.
Right. Houses are on sale. The
Mm-hmm.
opportunity for growth is there. As many have said, there's nothing like buying dirt to grow wealth.
Mm-hmm.
And by investing in a house, you are going to grow your wealth exponentially. You just have to be okay with the fact it's not going to happen overnight. But if you're waiting to see if housing values are going to come down before I start investing in the real estate market, you're making a mistake. Because we're likely to see values go up and interest rates go down.
Mm-hmm.
So if you're going to be buying, buy today. Don't wait for something to get different or better because anytime you do that, you're typically losing.
Yeah, absolutely. I think I can't remember the exact multiplier. Gary Keller said this. The homeowner has a net worth of either 10x or 30x. It was an insane multiplier in comparison to someone who doesn't own a home.
Oh, yeah, it's substantial. And actually it's very hard to do a percentage of X behind what percentage that is, because it depends on the region of the country you're in, right? And traditionally, obviously, the Midwestern part of the country has been one of the best regions in the country, not only to come into a housing crisis, but leave a housing crisis and have consistency of growth year over year when it comes to housing.
Oh yeah, absolutely. Well, Todd, thank you for doing
You're
this.
welcome.
Hopefully, we can create more content. This will be not just on YouTube, but on other podcast platforms. So hopefully, start to a new beginning and more to come.
Thank you for inviting me anytime.
Okay, thank you.